The Cyprus exit bridge is complete. Your principal's residency layer is secured. The holding company is domiciled, and the defensive architecture we constructed in episode 7 is now operational. That was the shield. What we build today is the sword. Delaware is not a jurisdiction. Delaware is an instrument, the most precisely engineered capital deployment mechanism in the history of private markets. When institutional allocators, sovereign wealth funds, and the world's most sophisticated family offices want exposure to US private equity and venture capital, they do not walk through the front door as individuals. They architect the pathway. And that pathway, without exception, runs through a Delaware Limited Partnership or a Delaware LLC, sitting beneath a non-US holding layer. This is illustrated in the capital architecture migration map. In episode 7, we were playing defense. The Cyprus structure, a holding company beneath a non-domiciled residency layer, was constructed to interrupt the chain of fiscal residency, to interpose a treaty-compliant entity between the principal and their legacy jurisdiction, and to create a structurally clean exit from legacy reporting environments. That architecture was necessary. It remains necessary, but it is insufficient for wealth growth at institutional scale. The limitation of a purely defensive structure is that it optimizes for preservation over deployment. Capital sitting in a Cyprus holding company, even a well-structured one with full treaty access, is not compounding at the rate that institutional-grade private equity and venture capital can generate. The top quartile US buyout fund has delivered net internal rates of return consistently above 18% over rolling 10-year periods. The top decile venture fund is a different conversation entirely. This is the asset class where institutional wealth is manufactured, not merely protected. The strategic shift we are executing is a migration from defensive structuring to offensive deployment, and it requires a new layer of architecture sitting above the US market, but below the principal. This is illustrated in the capital architecture migration map. The critical insight here is that these two layers are not in competition, they are sequential. The Cyprus holding company becomes the interface, the institutional gateway through which the principal accesses US structures without becoming a US person, without triggering US estate tax exposure on US Cyprus assets held in their own name, and without creating the reporting cascade that direct individual investment into a Delaware Limited Partnership would generate. This is the foundational design principle of the entire architecture. The principal never touches the Delaware structure directly. A non-US principal who invests directly as an individual limited partner into a Delaware Limited Partnership faces a specific and serious set of problems. First, US estate tax. Under Internal Revenue Code Section 2104 and the regulations thereunder, a non-resident alien's interest in a US partnership that holds US CETUS assets, which includes interest in US operating companies, US real property, and in most interpretations, limited partnership interest in funds investing primarily in US equities is potentially subject to US federal estate tax at rates up to 40%, applied above a $60,000 exemption threshold. Compare this to the $13.61 million exemption available to US persons under 2024 law, and the asymmetry is stark. For a non-US principal with a $5 million limited partnership interest in a Delaware buyout fund, direct individual ownership creates a potential $1.98 million estate tax liability on death. That exposure is unacceptable and entirely avoidable. Second, FATCA and the Form 8938 cascade. A non-US individual holding a direct interest in a US partnership triggers FATCA adjacent reporting at the fund administrator level, and depending on the principal's country of tax residence, potentially requires disclosure of US financial account holdings under the relevant intergovernmental agreement between that country and the United States. The Cyprus domiciled holding company, by contrast, files a Form W8BNE with the Delaware Limited Partnerships Administrator, certifying its status as a foreign corporation, and positions the holding company, not the individual, as the investor of record. Third, effectively connected income contamination. A non-US individual limited partner who receives income from a Delaware Limited Partnership that is effectively connected with a U.S. trade business under Internal Revenue Code Section 871B, becomes subject to U.S. federal income tax at graduated rates and potentially triggers a U.S. tax filing obligation under Section 6012. The Cyprus holding company, structured correctly and managed with appropriate substance, does not carry that individual level exposure in the same way. This is shown in the Cyprus holding company as Treaty Gateway Map. The Cyprus holding company achieves three things simultaneously. It eliminates the U.S. estate tax exposure on U.S. Cyprus assets by interposing a non-U.S. corporate entity. It provides access to the U.S.-Cyprus Double Tax Treaty, signed in 1984 and updated via protocol, which sets withholding rates on dividends, interest, and royalties at treaty-reduced levels. And it creates the clean institutional counterparty that U.S. fund administrators and general partners expect to see. No sophisticated U.S. private equity or venture capital fund general partner wants an individual non-U.S. limited partner on their cap table. The administrative burden alone, the FATCA certifications, the potential effectively connected income allocations, the Schedule K1 complexities, is sufficient for many funds to decline. A Cyprus holding company presenting a W8 BEN-E is a clean counterparty. It is institutional. It fits the model. Delaware offers two primary vehicles for private capital structuring: the limited partnership, governed by the Delaware Revised Uniform Limited Partnership Act, and the limited liability company, governed by the Delaware Limited Liability Company Act of 1999. Both are extraordinarily flexible instruments. The choice between them depends on the specific deployment objective. For investment into third-party U.S. private equity and venture capital funds, the Delaware Limited Partnership is the standard vehicle. The structure consists of a general partner entity, typically a Delaware Limited Liability Company, wholly owned by the principal's family office or a trusted management entity, and one or more limited partner slots occupied by the principal's holding companies. This is shown in the Delaware Limited Partnership and General Partner Capital Flow Map. The General Partner Limited Liability Company carries the management authority. Under Delaware Revised Uniform Limited Partnership Act, the General Partner has fiduciary duties to the limited partnership unless those duties are explicitly modified or eliminated in the limited partnership agreement, which Delaware law expressly permits. This is a critical feature. In a family office context, the agreement can be drafted to eliminate the duty of loyalty to the extent the general partner makes investments in entities affiliated with the family's other interests, to restrict the duty of care, to exclude grossly negligent or intentional misconduct, and to establish indemnification provisions that protect the general partner entity and its managers from limited partner level litigation. No other U.S. jurisdiction offers this degree of contractual flexibility. This is visualized in the entity structure and capital waterfall map. The carried interest vehicle is typically structured as a separate profits interest in the general partner limited liability company. Under Revenue Procedure 93-27, a profits interest received for services is not immediately taxable as income if it meets specific requirements, primarily that the interest does not entitle the holder to a distribution in hypothetical liquidation of the partnership at the time of issuance. In a family office private equity deployment context, this allows the family's investment management team, potentially including next generation family members, being integrated into the investment process to hold carry in the general partner limited liability company without triggering an immediate tax event. The carry vests as the portfolio companies appreciate, and the economics are structured to qualify for long-term capital gains treatment under Internal Revenue Code Section 1 upon realization, assuming assets are held for the required period. This is detailed in the carried interest vehicle structure map. The Delaware Limited Liability Company is the preferred vehicle when the objective is direct co-investment or warehousing a specific asset rather than acting as a fund limited partner. A Delaware Limited Liability Company wholly owned by the Cyprus Holding Company can be used to hold a direct equity stake in a U.S. portfolio company, to warehouse intellectual property that will be licensed to U.S. operating entities, or to serve as the co-investment vehicle alongside a fund that grants the family office co-investment rights. The limited liability company's operating agreement provides the same contractual flexibility as the limited partnership's agreement, and the entity can elect to be treated as a corporation or as a disregarded entity for U.S. federal income tax purposes, a choice with significant implications for the withholding tax optimization analysis. The U.S. venture capital ecosystem operates on a specific structural logic that the principal's Delaware architecture must be designed to interface with cleanly. Understanding the venture capital stack is essential to understanding why the architecture we have described is not merely tax efficient but operationally necessary. This is modeled in the venture capital stack map. A U.S. venture fund is typically structured as a Delaware Limited Partnership with a management company, a Delaware Limited Liability Company, or a California Limited Liability Company, depending on the general partner's location, that charges a management fee, typically 2% of committed capital annually during the investment period. The general partner entity holds a carried interest of typically 20% of net profits above a preferred return hurdle. Limited partners commit capital at closing of fund. That commitment on a core capital basis as the general partner identifies investments. For the principal Cyprus holding company investing as a limited partner in this structure, the mechanics are as follows. The Cyprus company executes a subscription agreement and provides the fund administrator with a completed form, W8BN, certifying its status as a foreign corporation eligible for treaty benefits under the U.S.-Cyprus Treaty. The fund administrator maintains this certification and applies the appropriate withholding rates to any distributions that constitute U.S. source income. The W8BNE is not a static document. It must be revalidated every 3 years under Treasury Regulation 1.1441-1, or more frequently, if the entity's circumstances change in a way that affects its treaty eligibility. Allowing a W8BNE to lapse is a structural failure that results in backup withholding at 30% on U.S. source payments, an avoidable and administratively embarrassing outcome. This is detailed in the W8BNE certification lifecycle map.
For a non-U.S. entity investing in a U.S. limited partnership, the single most important tax classification question is whether income from the limited partnership constitutes effectively connected income or fixed, determinable, annual, or periodical income. Fixed, determinable, annual, or periodical income, which includes dividends, interest, rents, and royalties from U.S. sources, is subject to a flat 30% U.S. withholding tax under Internal Revenue Code Section 881. Reduced to treaty-level rates for entities qualifying for treaty benefits. Under the U.S.-Cyprus Treaty, the withholding rate on dividends paid to a Cyprus corporate shareholder owning less than 10% of the voting stock of a U.S. corporation is 15%. For interest income, the treaty reduces the rate to 0 in most circumstances. This is the primary treaty optimization available to the Cyprus holding company structure.
Effectively connected income is categorically different and significantly more dangerous from a compliance perspective. Under Internal Revenue Code Section 875, a non-U.S. entity that is a partner in a U.S. partnership is treated as being engaged in a U.S. trade or business to the extent the partnership is so engaged. This means that if the Delaware Limited Partnership, through its portfolio investments, is considered to be conducting a U.S. trade or business, which is a factual determination that depends heavily on the level of operational activity of the underlying portfolio companies and whether the fund investment activities themselves rise to the level of a trade or business, the Cyprus holding company as limited partner could be allocated effectively connected income. Effectively connected income allocated to a non-U.S. limited partner is subject to U.S. income tax at graduated rates, requires the filing of a U.S. federal income tax return, and triggers withholding at the partnership level under Internal Revenue Code Section 1446, which requires the Delaware Limited Partnership to withhold tax on the non-U.S. limited partner's allocable share of effectively connected income at the applicable corporate or individual rate. This is broken down in the effectively connected income versus fixed determinable annual or periodical income classification map. The primary structural mitigation against effectively connected income exposure in a private equity context is the trader versus investor distinction. a partnership that merely acquires and holds investment assets without providing services, without active participation in portfolio company management to a degree that constitutes a trade or business, and without engaging in frequent trading is generally treated as an investor rather than a dealer or trader, and its income is characterized as fixed, determinable, annual, or periodical income rather than effectively connected income. Most institutional private equity and venture capital funds are structured specifically to maintain this investor characterization for the benefit of their non-US limited partner base. Foreign Investment in Real Property Tax Act. The Foreign Investment in Real Property Tax Act, under Internal Revenue Code Section 897, presents a separate withholding concern for Delaware Limited partnership structures that invest in funds with real property exposure. Under this Act, gain from the disposition of a U.S. real property interest by a non-U.S. person is treated as effectively connected income, regardless of the investor-trader characterization, and withholding of 15% of the gross proceeds is required under Internal Revenue Code Section 1445. A Cyprus holding company investing in a U.S. private equity fund with significant real estate holdings must assess whether the fund constitutes a U.S. real property holding corporation, or whether its limited partnership interest in the fund constitutes a U.S. real property interest, as this determination drives a meaningfully different withholding outcome. This is highlighted in the Foreign Investment in Real Property Tax Act Exposure Analysis Map. The Delaware architecture we have built today is extraordinarily powerful. It provides the principal with institutional-grade access to the U.S. private equity and venture capital ecosystem. But it optimizes withholding tax exposure through the Cyprus treaty layer. It structures the carried interest vehicle efficiently. It maintains clean counterparty presentation to U.S. fund administrators and general partners. It eliminates the U.S. estate tax exposure that would attach to direct individual investments. But Delaware has a price. The price is sovereign exposure, and it is a price that must be understood, quantified, and actively managed before it is paid. Any structure with a footprint in the United States, even a footprint held through a non-U.S. holding layer, generates U.S. reporting obligations. FATCA requires foreign financial institutions to report U.S. connected accounts to the IRS, and the definition of U.S. connected is broad enough to reach a Cyprus company with a U.S. limited partnership interest in certain circumstances. The Internal Revenue Service formed 5,471 reporting obligations that attach to a U.S. person with an interest in a foreign corporation, and the potential application of the passive foreign investment company rules under Internal Revenue Code Section 1297 create a compliance surface area that must be mapped and managed with precision. More critically, the growth of the Delaware portfolio, the very success of the offensive deployment strategy, increases the principal's exposure to U.S. estate tax on U.S. Cyprus assets. If the holding structure is ever compromised, increases the FATCA reporting surface, and begins to create the conditions under which the Internal Revenue Service might argue that the principal has a sufficient nexus to the United States to warrant more aggressive examination of their overall tax position. These are not hypothetical risks. They are the specific, predictable consequences of building institutional-grade wealth through U.S. structures, and they require a dedicated risk mitigation architecture that we have not yet built. That architecture, the sovereign risk hedge, is the subject of Episode 9. In our next briefing, we will examine the specific treaty-level and structural mechanisms available to a non-U.S. principal who has deployed capital through Delaware and now faces the full weight of U.S. reporting obligations, the use of blocker corporations to interrupt effectively connected income flow, the role of offshore insurance wrappers in recharacterizing U.S. investment income, the treaty tiebreaker provisions that can be deployed if the Internal Revenue Service challenges the principal's residency position, and the specific portfolio restructuring triggers that indicate it is time to consider a partial exit from the U.S. structural footprint. The Delaware architecture is built, the capital is deployed. Now we must protect it from the jurisdiction that makes it possible. Join our community of informed investors to stay ahead.
This data is for education and is not financial advice. Always consult a professional before investing. To speak with one of our specialists, click the link in the description. I'll see you in the next report.